If you've clicked on this video, then I hope you're expecting to learn about IRAs, because that's what we're going to cover. We're going to cover traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, self-directed IRAs. We're going to talk about conversions, rollover, contribution limits, income restrictions. It's a lot to cover and we're going to move fast, so hang on. Individual retirement accounts are tax-advantaged retirement accounts that are owner-managed. They were created in 1974 by the Employee Retirement Income Security Act, or ERISA, which paved the way for people to control more of their retirement saving themselves. IRAs were primarily designed for small business owners and people who work for small businesses, but really anybody can use them. Now, as long as you have earned income, you can contribute to an IRA. There are literally hundreds of custodians, maybe thousands, who are willing to help you set up the accounts. And within the account itself, you can really own just about any asset: stocks, bonds, mutual funds, real estate, you name it, with the goal of developing a portfolio that will sustain you in retirement. First off, let's talk about eligibility a bit more. We already said that anyone with earned income can set up an IRA, with the exception of SEP and simple IRAs, which are for small business owners. But you are limited to contribute only up to the amount of earned income you have in a given year. So the contribution limits in 2023 are $6,500 for an IRA, $7,500 if you're 50 or older. But if you only made like $3,000 of earned income in a year, you can only contribute up to $3,000. Now, earned income is income from a job. It doesn't include real estate income. It doesn't include capital gains. It doesn't include inheritance, things like that. It has to be earned income for you to be eligible to contribute that money to an IRA. If you're already contributing to an employer-sponsored retirement plan like a 401k, a 403b, or 457, you can still contribute to an IRA. That in of itself will not disqualify you. But there are some income restrictions depending on the type of IRA you're using, and there are some restrictions on how much you can deduct based on your income. We'll cover those limitations as we get to those types of IRAs later. Okay, speaking of IRA types, the first and most popular type is a traditional IRA. A traditional IRA basically means that you make contributions to the account on a pre-tax basis or tax-deferred basis. In other words, you deposit funds in the account. Let's say you put $6,500 in 2023. That means that $6,500 is tax deductible when you do your taxes. It comes out of your taxable income. The money can then grow tax deferred until you make withdrawals. Withdrawals from a traditional IRA are taxed as regular income. Now, there are limitations on how much you can take as a deduction for a traditional IRA contribution each year. It's based on your income and your access to another employer-sponsored retirement plan. We've got all that listed on the screen. I won't bother reading it to you. But just know and be paying attention to that, because if you can't take a tax deduction for a traditional IRA, it may be a good idea to do a Roth instead. I also want to point out that you can still contribute to an IRA even if it's not deductible. You can do that on an after-tax basis. You won't get the deduction, and you may wonder to yourself, why would I want to do that? If I don't get a tax deduction, what's the point in putting it into an IRA? Well, there's another strategy you can use to get money into a Roth IRA we'll talk about in a bit, using an after-tax contribution, so stay tuned for that. There are early withdrawal penalties if you remove money from a traditional IRA before age 59 and a half. And that's true for basically any IRA. There are ways around that. We've done another video, which we'll put a link to over my head here in the description below if you want to look into details about that. Okay, speaking of Roth IRAs are similar to traditional IRAs, but the difference is you don't take an income tax deduction when you make a contribution, but your withdrawals are completely tax-free. So earlier we gave the example of someone who contributed $6,500 to an IRA in 2023. If you make that contribution into a Roth account, you don't get a deduction on the contribution, but all of your withdrawals in retirement are completely tax-free. So one way to look at this is a traditional IRA, you pay tax when you make withdrawal. On a Roth IRA, you pay tax when you put the money in the account. Now, it's important to remember that if your tax rate doesn't change from the time you make a contribution to the time you make a withdrawal, there's really no advantage of traditional over Roth. Generally, you want to use a Roth when you're in low income tax brackets. You want to use a traditional when you're in high income tax brackets. We've also done a video to help you navigate the Roth versus traditional decision, which we'll put a link to below. Also, since Roth IRA contributions are made on an after-tax basis, you can remove the contributions at any time, tax and penalty free. So that's just the piece you put in. Any earnings or growth that are made off of those contributions, you cannot remove those before age 59 and a half without an early withdrawal penalty. But your cost, your basis, the amount you put in and fund the account with, you can always pull out. So in a way, people kind of think of this as sort of a backup emergency fund, although we don't recommend that you remove any money from the account till retirement. Roth IRAs also come with a 5-year rule that basically requires you to have the account open for at least 5 years before you begin making withdrawals. That's true at any age. And finally, not everyone can contribute to a Roth IRA. Your modified adjusted gross income must fall within the limits or below the limits on your screen. The vast majority of Americans are eligible to contribute to a Roth IRA. But if your income is above the levels that you see for your tax status, whether single or married filing jointly, there is another way to fund a Roth IRA. It's called a Backdoor Roth IRA, and here's how it works. Earlier we mentioned that you can make contributions to a traditional IRA on an after-tax basis, no matter what your income was. What you can also do with an IRA is convert funds from after-tax or traditional to Roth. So let's say you have money in an after-tax IRA that you make a contribution. You can do that at any income level and then convert that money to a Roth. A lot of people are surprised to hear that it's that simple to get money into a Roth IRA, but it's true. It's called a Backdoor Roth IRA. It's been kind of a loophole in the tax code since 2010. Millions of people have done it, so there's nothing illegal. It just requires an extra step for you to fund a Roth IRA. Now, you need to keep in mind the pro rata rule if you do this. The pro rata rule basically says that the IRS will tax all of your IRAs on a proportional basis to the taxable amount versus the non-taxable amount, or the pre-tax amount versus the after-tax amount. And what that means is any tax-deferred money you have in an IRA will be counted along with any after-tax money, and you'll pay a tax on the percentage of funds that haven't been taxed yet. So let's say if you had $100,000 in IRAs, $50,000 of a traditional, $50,000 in after-tax, the IRS would collect income tax on 50% of any conversion you make from a traditional to a Roth IRA. If you have a lot of money in a traditional IRA, this could create a big tax liability if you try the Backdoor Roth IRA. One way to avoid that is to move any funds that are in a traditional IRA into a 401k, therefore reducing or eliminating all of your traditional IRAs altogether, meaning your tax liability would be zero. And again, we've done a video about Backdoor Roth IRAs. We'll link that in the description below as well. In addition to being able to convert funds from a traditional IRA to a Roth IRA, you can also roll over funds from, say, a 401k, 457, or 403b into an IRA. This is commonly done if you change employment. Some employers will allow in-service rollovers from within their plan, but basically you're just going to move the money from one account to the other, but you have to be careful doing this. So the rule is if you do a rollover, you have to move the funds within 60 days from one account to the other. Otherwise, it becomes taxable. But there's a way to avoid tax liability altogether. By doing what's called a direct rollover from your employer-sponsored plan custodian to your IRA custodian, you never touch any of the money, and therefore there's no opportunity for the IRS to consider it a distribution. Now, direct rollovers take a little more coordination and communication between, one investment company and another, but it's well worth it because it completely eliminates the risk that your entire 401k balance could be considered a distribution. There are a few other types of IRAs we want to talk about now. The first one is a self-directed IRA. Basically, a self-directed IRA gives you the opportunity to own more specialized investments within an IRA account. So you can own things like real estate, partnerships, businesses, land. There's all kinds of things you can put. There's really not a limitation on what you can put in a self-directed IRA. Self-directed IRAs are subject to all the income restrictions, limitations for withdrawals, the RMDs, all sorts of things that a regular IRA is. It's just the assets within the account are completely different. Now that difference does call for some specialization. You wouldn't want to set up a self-directed IRA on your own. You also wouldn't want to just set it up through anybody. There are people who are professional who do this regularly. If a self-directed IRA is something you want to look into, you need to contact someone who does them often. Simplified Employment Pension IRAs or SEP IRAs are for small business owners or self-employed individuals. All the withdrawal restrictions for SEP IRAs are just like other IRAs. Key differences are that you can contribute up to $66,000 in 2023 to a SEP IRA or 25% of your income, whichever is less. Business owners can set up SEP IRAs for the employees, but the employees are not allowed to make contributions to the account, but any contributions the employer makes are tax deductible. Savings Incentive Match Plan for employees, or simple IRAs, not a very simple acronym, are simple to SEP IRAs with the key exception that employees are allowed to make contributions to the account. Employers are also required to make contributions to simple IRAs, but those contributions are tax deductible. For 2023, employees can contribute up to $15,500 to a simple IRA and another $3,500 if they're age 50 or older. We've already touched on one of the most significant restrictions to bear in mind as you own an IRA account. That being that you can't make withdrawals until age 59 and a half. Now, if you do make an unqualified distribution from an IRA before age 59 and a half, you'll owe a 10% penalty and income tax on the distribution. There are a few hardship exceptions to IRA rules, and they do vary depending on traditional or Roth. One is like medical expenses. You can use a Roth account to buy a first home. You can use a Roth account to fund college tuition. So if you think any of those apply to you, you should look into that. Also, we briefly hit on the 5-year rule for Roths. So if you think you'll need access to the money that's in the account with a 5-year period, be sure you look into the 5-year rule and know what those rules are. So another characteristic of IRAs is required minimum distributions. Required minimum distributions exist to ensure that people who fund accounts with pre-tax or tax-deferred dollars have to pay income tax on those contributions at some point. Potentially, you could leave money in an IRA until you die and never pay tax on it, but RMDs force your hand. So at age 73 or 75, you'll be forced to begin removing money from your IRA account so the IRS can begin taxing that income. The amount you withdraw is based on the Uniform Lifetime Table from the IRS's website. You can look it up. Basically, it just gives you a number based on your age, and you divide that into the total IRA balance on December 31st of the previous year, and it gives you your required RMD that you must take out of the account before December 31st of the following year. If you die before you exhaust the funds in the account, any heirs that receive the IRA will be forced to continue making RMDs until the account is completely eliminated or 10 years after your death, whichever occurs first. From a tax perspective, RMDs make perfect sense. You can't shelter that money forever, I get it. But there's a chance when you reach age 73 or 75, you won't actually need the money that's in your IRA. In many cases, people find that income from Social Security or pensions or other sources is more than enough to live on. Therefore, RMDs could create a tax liability that you don't really want. To avoid this, you can begin converting assets from a traditional IRA to a Roth IRA before you reach RMD age to limit their impact. Now, Roth IRAs are completely exempt from RMDs, so it's a good place to put that money if you want to avoid them. Also, if you're charitably inclined, qualified charitable distributions are an option to reduce your traditional IRA balance. Basically, what that means is any distribution you make directly to a charity from your IRA will reduce your RMD liability for that year on a dollar-for-dollar basis. So if you have a charity, let's say the World Wildlife Fund, and you want to give them $10,000. If you had $20,000 in RMDs for that year and you sent $10,000 to charity, your new RMD requirement is $10,000. We also have several videos on Roth conversions and qualified charitable distributions, which we'll link in the description below as well. One last thing to mention about IRAs, if you have access to an employer-sponsored retirement plan and there is any matching component at all within that account, you should probably direct retirement savings there first. And the reason is the money that's given to you by an employer in an employer-sponsored retirement plan is completely free. There's no obligation for it. You don't get that in an IRA. So be sure you're taking advantage of an employer match if you have access to that. Once you've maxed out that employer match, then you can come look at an IRA, traditional Roth, depending on your tax basis, and begin funding that. So that's it, IRAs. That was a very, very high level explanation of IRAs. For more about IRAs, just look in the description below. We've got tons of other videos. We've got blog posts. We've got playlists. You can also check out markmoney.com anytime for just about anything related to personal finance. As always, we're so grateful for your time. God bless and take care.